How's everybody doing? Welcome to another episode of BayView Views. I'm Mark Dutram, and today I want to share with you a little bit about kind of the S&P 500 and where it's at year to date. It looks like it's doing very well for the year, considering we're trying to slow the economy down. We've been raising interest rates, but I want to talk specifically about that benchmark because it's so broadly used, right, to measure how well we're doing. And then the second thing I want to talk a little bit about is our factor-based investing and value and size and how that's kind of panning out year to date as well. And then just to be aware of kind of the sample periods that we actually look at. So let's start with kind of the S&P, and we'll talk about its concentration, right? So we're talking about 500 stocks as a benchmark for the overall health of the markets, right? So this chart behind me shows me, again, how the S&P is doing year to date. And guys, this is through August 14th. So this is current data. And as a matter of fact, if we looked at this stuff through May, it was even more stretched. And I'll share with you what I'm talking about. But so if you took the top 10 stocks of the S&P 500, and these are the ones that we have been following for so long, Apple and Google and Meta and all of these stocks that have done so well, NVIDIA. Right today, if you look at it, those top 10 stocks represent a price earnings ratio of 27, right? So that would be considered probably expensive when you look at historically it was trading around 20. The overall S&P itself is trading at around 19. And then the remaining 490 stocks are trading at around 17. So you can see this differential between, again, the top 10 and the lower 490. We can also see here that the top 10 now represent 31% of the overall market cap of the S&P 500. That's incredible. And you can see where that measures from a historical perspective. Right? And then even their earnings contribution, they contribute now 21% to the broad market benchmark. So very concentrated, right? If we look at this now, if we look at the earnings or the rates of return, this is the rate of return of the top 10. This is the rate of return of the bottom 490. And there was a time of year through May, as a matter of fact, where they were essentially flat or zero. This had made nothing, right? So you can see the overall S&P is here, but the 490. So you have a very huge disparity between the top and the bottom. Now we're starting to see a little bit more breadth of the market where it's coming back, and you can actually see positive returns for those 490. But that's not healthy. Again, we want to see broad market growth so that we're not paying too much for just a basketful or a handful of securities. So that's something again we're watching closely, and so are the pundits on how they evaluate that index and whether it even needs to be reconstituted or something of that nature. So the other thing I want to talk about is remember, we always preface that small cap value, this box right here, should be the best performing style box in your Morningstar box. And if we look again year to date, you can see large cap growth, is up 28 versus small cap value is up 7. So that's quite humbling for us because again, we have a tilt towards this box. And if you took the S&P is probably this box. It's probably large cap blend, and you can see that it's up about 17% year to date. So you might look at that and you go, wow, is that, Mark, how is this going to make that up? And so what we have to do is kind of bring your attention to the sample periods that you look at. So, some might see that and kind of lose hope and say, no, I think maybe large cap growth or large cap value or large cap blend is going to be the best performing. But this is really important. So if we look since 2010, you can see that, again, the S&P 500 versus small cap value. This is this line here. So the S&P since 2010, and this is all the way through May of this year, The S&P is up 12.5% annualized versus the small cap value, which is up only 10, right, or 10.8. So that's a long period of time to really underperform with these factors that we're looking at. But then what you have to do is say, well, wait a minute. Well, what about maybe the prior decade? And so if we look at the prior decade, guys, look what happened. Small cap value was actually up 12.3% annualized versus a negative, right? We call that the lost decade. And then, that's kind of a rough time period for large caps. But if we look historically, and again, we've got a lot of data that goes back. And so this is from 1927 through the current time. Large caps, again, up 10 versus small caps up 13, right? And specifically small cap value. So, again, we don't abandon our factors. We don't, again, we're kind of unapologetic about that. When you have periods of underperformance of small cap and value, it doesn't mean it doesn't work, but there are times where, yes, again, it's not going to win every year. And that's why we say it's a premium, not a promise, right? It's not a guarantee. But I do think it's quite relevant as we look at that today, and specifically, looking at the premiums and how they perform. So anyway, I hope this sheds some light again on the S&P. You may not have known that there was so much concentration in that. And then a little bit of light to, again, those that we're investing money for, where those premiums stand today, but where they stand, historically. So, hey guys, this is another episode of BayView Views. I hope this has been insightful for you. Happy investing. If you have any questions, give us a shout, okay?